It's a real pleasure to be here today and to kick off this conference on global governance. There's no question the events of the past year have completely shaken our confidence in the global economy and in the global financial system. We've had the greatest depression or greatest recession since the Great Depression of the 1930s. You know, it was not too long ago that we were having 5% GDP growth a year. From 2004 to 2007, the world averaged 5% GDP growth. It used to be that a recession meant that world GDP growth would drop to 2.5%. Well, just the other day, the World Bank issued their revised forecast for 2009 for the world economy, minus 2.9%. In my country, the US, we've lost about 6 million jobs. In China, we've lost 20 million jobs. In my country, we're flirting with an unemployment rate of 10% or more. It wasn't very long ago we had an unemployment rate of 3.9%. We've really witnessed a complete implosion in the financial sector. We've destroyed tens of trillions of dollars of financial wealth. The IMF recently estimated that from 2007 to 2010, global financial institutions would be writing down $4 trillion of assets. Former Fed Chairman Alan Greenspan used to exude confidence in the global financial system. A few months ago, he was quoted as saying that the financial system was crumbling and he wasn't sure what would happen next. We've seen the bankruptcy of some major icons of American business, General Motors, Chrysler, Fannie Mae, Freddie Mac, AIG, and so on. We've also seen some governments that we thought would have AAA bond ratings in perpetuity. I'm talking about the UK, even the US. We're seeing some of those AAA ratings questioned because of the policies. And we're seeing the Chinese government lecturing the American government on what it needs to do to get its house in order. They're saying that they might take their investments and go to less risky waters if we don't clean up our act. Well, clearly we've seen many things in the past year that we did not think we would see. We like to talk about stress tests. Well, the world has had one gigantic stress test the past year, and it's challenged the whole system. I think it's great that this conference is focused on global governance issues. What I'd like to do today is spend a few minutes going over some background information. How did we get into the crisis and so on? And I hope that we have our experts over the course of the day shed more light on some of these topics. What I'd like to do is focus on three questions. First, as I said, what were the main causes of the global financial crisis? In many ways, this was made in America, and so I feel very qualified to talk about what some of the causes were. Second, I'd like to talk about a few principles for regulatory reform. And third, I'd like to talk about the global governance challenge, especially on economic policy. Well, let's start by talking about the causes of the financial crisis. I believe the most important contributor to the crisis was easy credit that existed in the first half of this decade. Quite simply, the Federal Reserve kept the monetary floodgates open too wide for too long. In the period 2002 to 2005, the US had come out of the recession of 2001-2002, but we kept the Fed funds rate very low, at 1% for way too long, and monetary policy basically got behind the curve. When we had these very low interest rates, we had very low mortgage rates, especially variable rate mortgages, people could get a mortgage for 2.5% or 3%. What this cheap capital did is it became capitalized in the value of houses. Housing prices went up 10% a year, 20% a year, 30% a year, and so on. And basically, we developed very unreasonable expectations for what housing prices would do. Many people assumed that housing prices would only go up and up and up. By 2005 and 2006, virtually every economist knew that something was getting out of line. We looked at affordability measures. They were through the floor. We looked at measures of like the average price of houses divided by median income. By all of these measures, we knew we were getting in bubble territory, but we still didn't stop. Second key development in a cause of the crisis was financial innovation. Basically, these radically changed the mortgage business. The most important development was mortgage securitization. This was the bundling of pools of mortgages, their underwriting, their sale to institutional investors. This increased liquidity and spread risks, but it brought some benefits and some costs. Securitization gave access to cheap pools of borrowing around the world, especially from international investors. It made mortgage money cheaper. By some estimates, the flow of Chinese money into the U.S. market in the last 5 years suppressed or depressed mortgage rates by about 150 basis points. In other words, we artificially lowered mortgage rates because of the flow of Chinese money into the U.S. and international money as well. Now, one of the downside risks that came about from this securitization process was what economists call the agency problem. It used to be that the person or the institution that originated the mortgage held the mortgage to maturity. So they had a very strong interest in doing due diligence to make sure that the mortgage was clean, they understood the qualifications of the borrower, and so on. As we moved to securitization, we lost this interest in doing due diligence. The person who originated the mortgage was going to be selling it within hours or days to the next institution in the food chain, and so they did not have a strong interest in doing due diligence. Meanwhile, many firms started to loosen their lending standards to remain competitive in the market, to increase their market share. There was a relaxation of down payment requirements. There was a proliferation of new innovative mortgages. We had words like no doc loans. That means no documentation required. You didn't have to prove you had a job even, or you didn't have to prove your income. We had teaser rate mortgages. Get in for a really cheap price the first 6 months and then take your chances on where rates would go. We had what were called option payment mortgages. You could make your own choice of how much you were going to pay per month. Well, interestingly, with the option payment mortgages, about 90% of the families who took these made the very minimum mortgage, meaning they were actually adding to principal every month. Well, what happened was down payments dropped from 20% to 10% to 5% to 0%. And as a result, of course, the loan-to-value ratios were going up. Anyone who's in the mortgage business today can tell you that the loan-to-value ratio is one of the best predictors of credit default, of default risk. A third key factor in the financial crisis was a very fateful decision that the Securities and Exchange Commission made in April 2004. Christopher Cox was the chairman of the SEC, and he made a decision. It was on my birthday, April 28, 2004. He decided to allow the largest investment banks, the 5 largest investment banks, to increase their leverage ratios from 15 times to 35 times. What this meant as we increased leverage ratios was that there was much less of a cushion in hard times. Some of these firms had shareholder equity of tens of billions of dollars and outstanding obligations of $1 trillion or more. What this meant was that if there was a downturn, there was very little shareholder equity to fall back on, and so if a firm suffered only moderate losses, it could basically be put underwater. And clearly, Bear Stearns, Lehman Brothers, these firms all had leverage ratios of 30 times or more, and this was exactly what happened. A fourth key factor in the crisis was oil prices. I actually believe this was a much more important factor than most people think. When oil prices zoomed up to $147 a barrel, this represented the equivalent of a very heavy foreign tax on American households.